Earlier this week, Berlin Hyp, a German regional bank, issued a bond with a negative yield. Chris Thompson, why should I buy a German bond with a negative yield, even if it's got the gold-plated qualities of Germany on it?
Well, for the very good reason that the Germans tend to honour their debts. And this is the point. In a world of negative yields, you are investing in a haven. If you hold that bond, you will not get your money back, not all of it, but you will get most of it back, which is more, some would argue, than paying other countries with dodgier credit records who will give you a premium.
Well, this is Greece, isn't it? And you can buy bonds in Greek banks, or issued by Greek banks, with double-digit yields. Why wouldn't I do that instead?
Well, it's the difference between the kind of sure bet of the German bank and the long shot of the Greek bank. Here we have the difference starkly illustrated. That yellow dot down on the far right is, of course, the Berlin bank yielding less than zero, and the blue flat line is the average yield on senior debt. Investment grade in Europe at the moment. So we have two Greek banks, Eurobank and Alpha Bank, both offering between 11 and 13% on their senior unsecured debt. Now, the question is, are these banks now safe enough that you should take a look? And post their recapitalizations last year, supporters would say, yeah, for 12 or 13% yields for senior debt, that's pretty tasty.
Okay, so they've recapitalised. Now, surely there's still the danger, though, that bondholders could be bailed in, that depositors could be bailed in, or that they could be forced into equity. How real a risk is that?
Well, if we look at the next graph, Greek banks late last year were forced to raise billions in capital. And in the case of Eurobank, for instance, it did this without recourse to tapping state aid. So you look at their Tier 1 capital ratio, which is essentially the buffer that creditors will have between them and any potential losses. And they are, in the case of at least three of the Greek banks there, above the EU average. Now, as regards political risk, you could say that if you wanted exposure to Germany, but you didn't want German yields, well then buy Greece.
But what about the economic fortunes? Because obviously the Greek economy is in a much weaker state than the German economy, so you have a weaker economy, you have negative interest rates, which are crushing banks' interest margins. Surely that adds up, even with that capital cushion, to a lot more risk in the Greek instrument.
You need to take perhaps a more benign view of the Greek economy. It is slowly, albeit it is emerging from over 6 years of deep recession. But if you focus on Eurobank, for instance, even during the worst of the crisis last year, those senior bondholders who stayed in senior bonds and opted against swapping for equity have seen their bonds perform as expected, which gives you an indication of a certain amount of safety.
So there you have it. Buy Greece, get Germany. Chris, thanks very much.